and a very good evening to all our investors and partners. I am Shikha Sood, Head of Products at Edelweiss Mutual Fund. Thank you for joining this call on Edelweiss Business Cycle Fund. It is our new fund offering and its NFO period is currently in progress. So to help us understand this business cycle category and the need of this fund in an investor's portfolio, I am joined by Radhika Gupta, our MD and CEO, and also Deepak Jain, our Head of Sales. Welcome, Radhika and Deepak.
Thank you.
Thank you, Shikha.
So just to set the context and please brace yourself, all our investors and partners, I'm going to throw some numbers at you. So where investment in equity mutual funds is concerned, we are witnessing a significant rise. And in fact, sector or thematic funds are witnessing highest net flows amongst all equity mutual fund schemes. And there are more than 170 sector or thematic schemes in the Indian mutual fund industry across 15 different types of sectors and themes. More than 2 crore folios we're talking about, an asset size nearing 4 lakh crore. And that is closing in on the largest mainstream category of flexi cap funds. So we are seeing keen interest in this segment, Radhika. And so I would request you to shed some light on where does this requirement of gaining exposure to significant sectors fit in terms of a business cycle fund. So when can one consider or how should one consider a business cycle fund, and specifically what sets our Edelweiss Business Cycle Fund apart?
Thank you, Shikha, and thank you to everyone who has joined this in large numbers, both investor friends and partner friends. And I think Shikha opened up the context very nicely. And I'm going to divide my comments and presentation into 3 sections. First is to talk a little bit about, build on what Shikha said in terms of the need for a product like this, the opportunities and challenges in terms of existing sector funds. The second is a little bit of what I call a master class on factor investing, and you'll see why. And the third is, of course, talking about Edelweiss Business Cycle Fund in particular. And after that, I think Deepak, Shikha, and I would be very happy to answer any and all questions that you may have. So keep them ready as I start. So I think let me start with what Shikha said, which is that, we know the kind of market environment that there is. A significant amount of money, in fact, 1/3 of the money that has come into equity funds is apparently into sector and thematic funds. And, there are cases for both sides, right? There is a side that argues in favor of buying sectoral funds. And if you see the data on the screen, what you see is that over the long term, the Nifty TRI, Nifty 500 TRI has given you about 15% return. Now, if you stay invested over the long term in any individual sector, you see 10, 15 sectors on your screen, the returns are very similar to the index. So I always say in the long term, everyone is equally good or equally bad, whatever it is, right? Now, the proponents of sector funds will, however, argue that there are definitive cycles that happen within each sector. For instance, realty has done extremely well in the last year. The last 3 years have been outstanding for capital goods, which is why you see a lot of manufacturing-based funds launched. In the last decade, there was a period from 2017 when financials did well. So all of this happens. Again, you can see some of these sector micro cycles here. Sectors have cycles that can last 2-3 individual years. So for instance, realty stocks hit their worst point in COVID when rentals were down, no new construction was happening, sales weren't happening. But after COVID, everybody started buying houses. There was a boom in real estate again, and those who had inventory were able to sell it. So you see the realty upcycle. So cycles are a reality for sure. And here is the opportunity and here's the challenge. If you can enter and exit the cycle at the right time, there is an opportunity to make money. However, entering and exiting cycles is extremely hard. The second part, exit, actually is the hardest part. Many investors, partners have come to me and said, we know how perhaps to enter a particular sector, but we rarely get an exit call on a sector. And the reality is, if you can't do entry and exit and you just buy and hold sector funds, there's no point because you will get average market returns and pay a lot of tax in the bargain. So sector investing is fundamentally cyclical, which is why timing it becomes difficult. It becomes difficult for investors, it becomes difficult for partners, and that is the solution that we've been trying to work on. Can you, rather than buying multiple different funds in a single fund, create a solution that allows you to move in and out of sectors very aggressively? So, not, I am using the words very aggressively, thoughtfully here, that really allows you to do dynamic rotation in a single product, which is tax efficient, where it's done in a sensible way so that you don't have to do it individually. Now, with us at Edelweiss Mutual Fund, whenever we launch a particular NFO, it's not about an NFO. Honestly, it is about finding a solution to a problem. And when we were looking to solve this problem, and we've been at it for a while, we also looked at whether existing funds that you may already hold in your basket solve this problem. And we realized that flexi cap and diversified funds do not take large sector bets. So what you see on your screen here is 3 diversified funds in the flexi cap category, and you see the Nifty. Now, I love to take the example of financial services. Financials is 30% of the benchmark of the Nifty 500. And if you see across times, all flexi cap funds are always holding between 25 and 30% financial services. Very rare to see a diversified fund holding 5% financial services or holding 40% healthcare, which is actually only 5% of the benchmark. So diversified funds, for their own reason, tend to mirror the benchmark in terms of sectoral allocations, which is where the business cycles category comes in. Some of you may be asking, well, why? Why is this happening? We have a belief that it may be because the process of predicting sectors, which is difficult for you, entry and exit, is also difficult for fund managers. The traditional approach that is used, if you see any business cycle fund presentation or if you see any sectoral macro presentation to identify sectors, is a 3-part one. One is you're trying to identify which part of the macro cycle you're in. Are you in a recession? Are you in a recovery? Are interest rates going to rise? Are interest rates going to fall? Is it expansionary? Is it contractionary? Once you do that, you try to link sectors to that cycle. So interest rates will rise, banks should do well. And then you try to find stocks. Now, the problem is this involves 3 layers of judgment. And judgment, as we know, can go wrong many times. I often joke that a month ago, if you had said that the BJP would get 240 in the election that just happened, markets were supposed to be down 20%. Here we are sitting at markets up 20% from the day when the election event happened. We've seen so many cases of small cap funds last year closed down for subscription, yet the small cap index has been up 40% since it's happened. And even our traditional macro relationships are being challenged. So tech is supposed to be a sector that does very poorly in recessionary conditions. It was the best performing sector in COVID. Banking is a sector that does well in rising interest rates. It's actually been a laggard in the last year of rising interest rates. So traditional relationships are breaking down. This process is becoming harder and harder for people to do, which is perhaps why we are increasingly mirroring the benchmark. And that's why we at Edelweiss Mutual Fund decided to approach this problem with a new route, and that is factor investing. Now, some of you who are on the call, or many of you, would be familiar with some of the factor products at Edelweiss. Balanced Advantage Fund is a very large fund at Edelweiss Mutual Fund. And for those of you who know the fund, it solves the problem of when to invest in equities and when to invest in debt using trend-based models. And for 15 years, our team has been doing factor investing. In fact, we are the largest team of we manage the largest amount of factor-driven AUM in active format in India today. So we thought, why not apply our factor investing expertise, which has worked very well for us in funds like Balanced Advantage Fund, to a new problem, the problem of sector rotation. And let me just talk a little bit about factor investing with some interesting data. And I always say that factor investing is nothing complicated, right? It is a way of putting into data and formula what you already do and what you already know of traditional fund management. So if you look at, many of you would know traditional fund managers, and I always like to quote examples, but many people know a former fund manager, Prashant Jain or Warren Buffett. These guys were known as value managers. And what is value? Value means buying relatively inexpensive companies. Those companies are usually measured on price to earnings ratio. Many of you know quality-oriented growth managers, someone like a Marcellus, who's written many famous books, who will buy companies like Maruti or Asian Paints, etc. Now, these tend to be high-quality companies. What is a high-quality company? It's a company where the financial metrics are quite nice, leverage levels are low. Often FMCG companies are considered quality companies. Then there is a factor called growth. We all know what growth is. It's earnings growth. And then there's something called momentum, which is 3 month, 6 month price change. Quality, value, growth, these are nothing but segments of the market. And they are approaches that traditional fund managers have. Factor investing just says, hey, instead of looking at the English, I'm going to look at the data and I am just going to apply rules. So that is all factor investing is. Many of you have also, I think, experienced factors in different parts. And all of you who've invested in mutual funds for many years know that at any given point in time, certain AMCs tend to do better than other AMCs. Who are more growth and value, growth and quality oriented AMCs did extremely well. Customers bought a lot of those AMCs. And there's no magic there. If you look at those periods, growth and quality as factors did extremely well. Growth and quality as factors in the last 2 years have not done as well. Now, recently you would see funds which has a more value-oriented style doing extremely well. Value has done extremely well in the last 2 years, but it had a very patchy run for the previous 4 years. So we learn, I think, two things from this. One is that if you bias towards a single style, if you're only buying value, or if you're only buying growth, or if you're only buying quality, your returns will be very cyclical because sometimes something works, sometimes something else works. In the long term, everything works, but in the short term, there's cyclicality. Uh, the second is there is a style called momentum, which seems to be reasonably consistent across time periods. And let's talk a little bit about momentum. Now, most people think momentum is price change and it is a very short term kind of factor. It's interesting to tell you that on average in a company, momentum lasts for almost 2 years because momentum in stocks is often triggered by a change in fundamentals of the stocks. Could be a change in CEO, could be a change in product line, could be a change in government policy. And that leads to a re-rating of the stock. First, the earnings change, market starts recognizing it. Uh, Eventually, what you start to see is sell side starts covering it. It becomes the domain of HNIs. Mutual funds start buying it. It enters an index. So momentum is actually much more longer term and fundamental. And this is some interesting data on the performance of different factors over 10 years in India. If you look at this data, it's interesting to know in a live audience, I would have actually quizzed you on which is the best performing. Momentum is the best performing factor in India. Everything does well. So the index does 16, growth, value, quality also do that. But in the long term, momentum beats everyone by about 10%. It's actually a very powerful factor. And it does well in both up markets and down markets. So a lot of people have these myths that momentum does well only in an up market. It would be just interesting to point you to the data of 2020 or 21, 22 as well. So that was factor investing. We also talked about sectoral rotation. Let me spend 10 minutes now talking about how we are bringing a solution together with these two products. Just to recap, we're trying to build an aggressive product that rotates across sectors dynamically so you don't have to do it. And we're trying to do this not by focusing on predicting the past, but by using data to look at what is doing well. So rather than focus on what will do well, focus on what is doing well, identify a bottom-up process using factor investing to build a portfolio. And this is what the process looks like. So we start with a universe of 300 stocks. This is broadly the large and mid cap universe and very little small cap. We'll talk about that in a bit. We apply a filter of corporate governance to rule out companies, on poor corporate governance that our risk team finds out. And then we start creating baskets. We create a basket of companies that are value companies. We create a basket of companies that are growth companies, and we create a basket of quality companies. And each of these baskets, why three baskets? Because sometimes value does well, sometimes growth does well, sometimes quality does well. But in each basket, we add momentum. So we pick up the value companies which are showing highest momentum, the growth companies that are showing the highest momentum, the quality companies that are showing the highest momentum. And finally, we come up with a basket of 50 to 60 stocks that form this portfolio. Again, just to repeat the process, you start with 300 large and mid cap names, cut down for corporate governance, find value companies, growth companies, quality companies, make three baskets. Within each basket, find the value companies with highest momentum, the quality companies with highest momentum, the growth companies with highest momentum, and you come up with a basket of 50 to 60 names. Now, how is the factor combination powerful? I think before showing you the results and what this produces, I want to show you a little bit of output. Most people are familiar with a sector like PSU banks, and they know that PSU banks in India have been called cheap for many years. In the blue line, you see the PSU bank index. Here you see the funds allocation to PSU banks. Now, people have been saying PSU banks are cheap since 2014, but there was no momentum because there was no price movement. This portfolio started buying PSU banks once it saw price movement, that is in the 2020-21, and really picked it up in 22-23. A criticism could be that, hey guys, you were looking at momentum, so you missed the initial stage of the rally. That's true. Momentum relies on data to move. So it does miss the initial 10-15% of the rally. But guess what? It also missed out. It missed out a 6-year wait. So momentum is able to capture a majority of the price return, price movement in a short period of time, rather than saying that something is value, something is cheap, one day it will turn around, one day the car will move. It says, listen, once the car starts moving, I'm going to jump on board that car. And that process works beautifully. This is PSU banks. This is another lovely example in technology. So you would know that technology has always been a quality sector, but in 2019, there was really no momentum. But COVID happened, technology companies posted growth, numbers started looking very good. Momentum showed up, we went to 35% technology in a single fund, and we kept there. Momentum also turned, IT companies started reporting bad results. Momentum turned, we went to nearly 0% technology. So you see the dynamism here. You're going from 35% to 0% technology. So momentum is able to give you very clear entry signals and also exit signals. And I showed you an example of traditional funds versus the index. This is what it looks like in this kind of fund. So in a sector like financials, this fund was 3% financials at some point, and then 22% financials at another point. Very rare to find a diversified fund with 3% financials. Technology, the fund had 25% exposure in COVID, in tech, and then cut down to virtually no tech exposure. Again, healthcare, 22%. You see this more dynamically here. When COVID just hit us and pharma companies were doing well, we were 40% pharma, migrated to then technology when we all started working from home, then moved into capital goods, and now have been sitting in sectors like energy or financials. Interestingly, in this financials, in May 2024, only 1% of the 20% weight was allocated to private sector banks. So extremely bold in its ability to take sectoral allocations. I'm just going to make a couple of other points before I open it for questions. One is that one of the interesting things about this fund is the portfolios are going to look very different from your existing traditional funds. So on the right are 10 common stocks that you'll see in most traditional mutual fund portfolios. This is the May portfolio. 9 out of 10 of them were absent in this fund. Only 1% exposure, that to an ICICI bank. So 9 out of 10 were absent. The portfolio you saw was actually the one on the left. So this portfolio is one that is going to look very different from your traditional fund portfolios. The second is, I know people have bought a lot of small cap exposure. this is a fund with limited small cap exposure. At any point in time, our small cap exposure is less than 10%. And the real idea is to give you what I call dal chawal, core exposure in your large and mid cap category to deliver a high alpha solution in your large and mid cap category. Finally, I think I should show you the results of all of this. So this is rolling return. This is trailing returns, and over a 5, 7, and 10-year history, you can see that the fund has ability to generate meaningful alpha, 5-7% alpha over the benchmark. So trailing returns are good to know. And I also want to show you rolling returns over a 5-year period. Over a 5-year period, NSE 500 has done about 14%. Fund has net of all churn costs done about 19%. So 5% alpha over the benchmark with a similar to slightly lower standard deviation or beta to the index. So it's a myth that because it uses momentum, it tends to be higher risk. No, actually standard deviation is less than the index. So over 5 years, I think the ability to generate meaningful alpha, of course, in years when momentum doesn't work, when there is no trend, the fund has periods of underperformance, I think 18, 19, it's important to show that. But the good thing with momentum strategies is that that underperformance is smaller. And when it bounces back in 2020, 2021, the outperformance is wide. So that is the idea. Let me just summarize once. A solution to the problem of let's buy manufacturing today and let's buy financials tomorrow, a way to do sectoral allocation in a single fund, an approach focused not on forecasting the future, but on using data by building a portfolio of 50 to 60 stocks of value, quality, and growth companies which are showing underlying momentum, so which are showing price recognition by the market, and an ability to generate meaningful alpha to the benchmark in the large and mid cap category and hold a portfolio that's very different from traditional funds. I think that is the solution. And the last thing I would say is that, at Edelweiss Mutual Fund, it is important to do things for us that we are good at and that we understand. We have been running factor-based funds for the last 15 years. 14,000 crores of AUM in factor-based funds run by Bharat and Bhavish. And I think a very rich track record across balanced advantage fund, aggressive hybrid fund, and large cap. And this is a category that is very, very core to us. So we are really excited to bring this to you. I think, Shikha, I can stop here unless you or Deepak or anyone want to add anything, and then we can take questions.
Sure. Thank you very much, Radhika. For simplifying the business cycle fund category and also establishing its need. We do have some questions here, but at this point, I would request all participants to post their questions in the Q&A section, and we'll be happy to take them. So Radhika, to start with, we have a question here. What type of investor is this fund suitable for?
Okay, I will take a cut, and if Deepak, you want to add, please do. I think this is very much a core allocation. This is not a satellite allocation. And I think it fits two core needs of an investor. One core need is for investors who are looking at a large and mid-cap fund category. If you want alpha in the large and mid-cap fund category in an actively managed fund, this is that. The second is for investors who, again, try to create a lot of alpha by moving in and out of sectors. We're doing it in one fund. Deepak, you want to add?
No, I think it's in simple terms, any investor who wants to increase the return profile of his portfolio without compromising on the volatility is perfectly suited for this kind of a product. Also, the best part, this question may come, Shikha. The best part about this strategy is that when we ran it for SIP as well as lump sum, the performances were similar. So for a 10-year back testing, the strategy is delivering lump sum return of 24%, as well as SIP XIR of 24%, which is amazing, which doesn't happen in most of the funds, especially in an upward ticking market.
Sure. So just taking off from there also, Deepak, there is a question, lump sum or SIP? What's the recommendation?
So that's what I answered. I knew this question would be coming. If you have a 3-year plus view, and the reason I'm saying 3-year, because the model has shown that it beats on 95% of the times the benchmark, and on an average by 5 to 6%. So if you have 3-year plus money, if that money is meant to be deployed in equity, by all means look at a portion to be deployed in lump sum. And if you have more money to be deployed over a period of time, choose SIP. But our back test shows us that lump sum returns over 10 years were 24%, as well as XIRR on SIP was also 24%, which means there may be a volatility in this fund from a month on month basis, but that gets very fast captured within a year's time frame. So that's really fantastic thing about this product.
Great. Thanks, Deepak. And so Radhika, so you did go through that this is a model-driven approach. So what is the rebalancing period, and how does this differ from any other factor-based passive fund that is available in the market?
Yeah, so good questions. So we tend to rebalance 8 times a year, 4 times a year. Earnings data changes, and of course price data is very dynamic, but we have to find a time balance between being nimble and of course rebalancing and not paying excessive churn costs. So we rebalance 8 times a year approximately. And that gives you a distinct, I know passive funds are popular in the momentum space. I'll make a couple of points on churn. One is everything we've shown you is of course net of churn costs, so that is important to know. Mutual fund, by the way, is a very efficient platform to do churn because the customer doesn't pay tax on churn, unlike PMS or AIF or those kind of platforms. Now, versus a passive index fund, the most common proxy you get are momentum-driven index funds. We have a very popular mid-cap momentum one as well. I think there are 2-3 differences. One is that because it's an active fund, we can do risk management here. So if there is an event in a stock, if there's a governance issue, we can and we will take care of that. So that is one difference. Second is, I want to caution and say this is not a blind momentum fund. Deepak uses the word sanskari momentum. I use the word responsible momentum. But while momentum is there, these are companies. The first filter is either the company has to have value, or it has to have growth, or it has to have quality. It has to have something about it and also have momentum. So that is a little different. And the third is rebalancing. Most passive funds rebalance once in 6 months. That's when the index changes. This is 8 times a year.
Great. So Deepak, probably if you can take this one. It's a very specific question. So there's an investor who is an OCI card holder, citizen and resident of an EU country, and has a NRE account in India. So what's the best way for this investor to invest in this fund?
No, I think you can find a mutual fund distributor or an advisor and use a platform that this so advise you. Or if you want to come directly, then Edelweiss MF's website is meant for you. There is no problem. You can invest.
So
you don't necessarily have to be in India. Only the US and citizens from North America has to be physically present in India before investing. For citizens or OCI card holders based out of EU countries, there is no such problem.
Sure. So Radhika, you did mention during our presentation that there would be a very dynamic sector rotation in this fund, and that this fund will invest in multiple sectors. So doesn't that increase the risk of this strategy?
No, if you go back to risk numbers, and I think questions are answered with data. If you look at risk numbers, let's look at standard deviation over a rolling 5-year period. Index is 16%, this is 15.7%. If you look at minimum return over a 5-year period, index is -1, strategy is 4. Now, is there dynamic sector rotation? Yes, there is dynamic sector rotation, but there is also alpha creation that comes out of it. And keep in mind, this is not at any point a single sector fund, right? So at some point it had 40% in pharma and healthcare, it had some technology, it had a couple of other sectors. We cap individual sectors at 40%. Today, by the way, if you look at the May portfolio, because the market rally was broad-based and there were a lot of companies in momentum, it was a bit more diversified. So it's more actively managed. It's taking a lot more sectoral risk, but aggregate risk is not higher. I should mention this portfolio doesn't hold 5 to 10 stocks. It holds 50 to 60 stocks. Each is on average 5-6%. So the area we are taking risk is very clear sectoral allocation.
Also, just to add to what Radhika is mentioning, risk in the investing parlance is about the deviation from the average return that the market or the portfolio delivers. So if market is delivering 20% and you are at 10%, then there's a 10% risk that you have not been able to participate. Risk is not only understood by, your capital risk. That, of course, is there in any investment. But as far as mutual fund investment, portfolio investment is concerned, it's about deviation. So if you don't participate in any upside, a significant upside, you will not participate in the fall. But that also means that you will not participate in the return making exercise.
Sure, sure. Thanks for that explanation, both Radhika and Deepak. We have another question around. So, Radhika, though you did mention that there are you pegged it against even large mid-cap offering or flexi cap offerings. But can you summarize that how does this strategy differ versus other diversified or large mid-cap offerings, and why should one consider this versus the others?
I think the answer, and I'm going to show this slide as I do this. I'm going to show you two slides again. And it's a great question. I think the core of this strategy is aggressive sector rotation, and you saw that in the previous slides that I showed. If you look at existing flexi cap, large and mid cap funds, etc., they don't take aggressive sector calls. I think you see that in the data on your screen. As I said, look at financial services, look at the allocation to IT, look at the allocation to healthcare. By the way, if you look at many existing business cycle funds that follow a traditional approach, the data will not look very different. So the biggest reason for difference is the dynamic, very dynamic sector rotation. And the second reason for difference is the factor investing approach, which these funds don't employ.
So Radhika, just to add, if you look at these portfolios, it looks like that we are living in the same kind of world for last 4 years, which is not the case.
Yeah. I'm just going back to that portfolio. Yeah.
So if you look at the portfolio construct, I mean, 30% financial services, 10 odd percent IT, 5 odd percent healthcare. I mean, you had 2021, the biggest event in our lifetime, COVID, then work from home for a year for the entire year, 21, 22. 22, 23 saw a big recovery in, rebound in the world. Oil moved from 60 to 120 back to 80. You had interest rates moving up and now down. So many changes has happened in the global economy, Indian economy, and the portfolios, represent the world as if it is a stale world, which is not the case.
And I think just to take that, you see the staleness here, and I compare that here to how dynamic the approach has been, where at some point, as Deepak said, you were much more IT and healthcare biased and very low on financial services. And then you changed to being a lot more capital goods biased and then a moderate allocation to financial services.
Sure. So what's the ideal investment horizon? So there are questions around, is this fund for me if I'm an investor for 5 years or 10 years, or even there's a question on 25 years. So what's the ideal investment horizon, and can someone stay invested in this for a 25-year period?
I'm very happy to hear not 1 year and 3 years. I think 5 years is a great starting point for the fund. And the reason it's a great starting point for the fund is 5 years is a very good time for equity. Second, if you look at the 5-year rolling back test, 100% of the time the portfolio is able to deliver outperformance over 5 years. Is it a portfolio for 10 years, 25 years? Yes. It's not a seasonal fund. This is very much a core allocation and all-weather allocation. It's not a seasonal allocation.
Great. So, Radhika, this is an NFO, and there would be allocation made into securities post it opens, post the allotment date. So, considering the environment and the market levels are very high, so would the fund manager wait and wait for an appropriate time to invest into the underlying securities, or how would that work? What's the period, or how much would it be staggered?
So we have a very clear policy for all equity NFOs that we do immediate deployment. And if you want to take a call on staggering your investments, then you can do it by way of SIP, STP, whatever form of staggered. We in the fund are going to be 100% invested from the beginning. This policy has been an old Edelweiss Mutual Fund policy, and it serves us really well because the premise of this fund was that prediction is very difficult. I do believe that for fund managers, deployment and taking those decisions is very difficult, and there's really no basis to do it. Anyway, in this particular fund, the question is a little, it matters even less because for the given cycle, right? For the given market environment, there is a right portfolio, and if market environment changes, the portfolio will change, right? So in this case, anyway, it doesn't matter as much, but in general, whether, and we've seen this, we launched a multi-cap fund in November or October last year, and markets had just had a volatile run, and we got all this advice कि आप immediately मत deploy करिए, थोड़ा देख संभल के कीजिए. We deployed whatever 1100, 1200 crores in one day. It served us super well. Fund is up, a meaningful number since then. So it is a policy for us that has served us well.
Just to add to what Radhika mentioned, Shikha, on 30th of July, the allotment is due because the fund closure is on 23rd of July. And most of the portfolio deployment will happen on 30th or 31st. So on first week of August, we will be able to share completely invested portfolio to all our investors.
Great. So the next question is around risks, Radhika and Deepak. What are the key risks of investing in this fund? And it looks like this fund would have a relatively higher churn. So should that be a concern or worry?
So I don't think churn should be a worry because everything that we've shown you is net of costs. And really, I think there are different strategies and momentum strategies or strategies that use momentum do have a higher churn because it leads to a certain amount of active management. Now, will the portfolio always outperform? Of course not. I mentioned this point, I'll repeat it again. In rapidly uptrending years, the portfolio does well. In rapidly downtrending years, the portfolio does well. In markets that are more flat, we've experienced this in balanced advantage fund as well. The fund tends to have patches of underperformance. I'll point out again 2018 and 19, which were rather flat periods. As I said, the underperformance margin is typically small and made up. Now, look at 2020, by the way. It's a great example. It's a year where we saw the COVID meltdown, and then it's a year where we saw a huge rally. But you saw two sharp trends, and the portfolio was able to capture that. But otherwise, the risks are those associated with equity investing. Deepak, you want to add?
Yeah, also, so we do want to talk about the fact that in a sideways market, you may not necessarily able to capture any outperformance, but there are periods like 2015 and 16. If you look back, where the Nifty delivered only 0 and 5, and yet the strategy was able to deliver 11. And this happens in our balanced advantage fund also. What we are trying to convey is that this strategy is not meant to work in a sideways market, but for all we know, it may actually deliver outperformance. But it's important to understand that in any sideways market, for example, the period between 18th of October 2021 till March 2023, those 18 months were excruciatingly painful for people following a trend-based strategy where the market moved nowhere. So those kind of periods, we will underperform by 2%, 3%, but you should look at periods where we outperform.
Yeah.
Outperformance is close to double digits in most of the cases. And that's why this 6 to 7% outperformance has emerged over long term, 3-year plus 5-year period.
Okay, sure. So will this fund invest in foreign securities or would be 100% in equity stocks?
So the fund is enabled for foreign securities, but we don't plan to invest. All our funds are enabled, are wide mandated, but we will not invest in anything globally. It's all domestic.
So Radhika, while you did speak on the portfolio, since there is a question, I think it would be helpful if we could go back to the slide on overweight, underweight of the portfolio, since an investor or a partner would like to know on what's the sector split currently looking like.
So this is May data, guys. We are showing May data in this presentation. This is the portfolio as of May. So you could see that, for instance, private sector banks in May were only 1% when the Nifty was 16%. So very sharp opinion there. Capital goods, power, non-bank financials were overweight, to some extent consumer durables. So that is what the sectoral weights look like. Keep in mind, as Deepak said, this will be deployed on July 30th, which means we are going to run the data again. So if a sector is certainly in momentum, then that will start changing. But this is what the May portfolio looked like. This is what the stock portfolio looked like for those who are interested again. As I said, in May, it was underweight 9 of the top, the usual suspects. The overweight stocks are what you see on the left. And I would repeat, if you look at the overweight stocks, these are different companies, but they are fundamentally sound companies.
Also, Radhika, there's a question on Can you illustrate or demonstrate or give a sense on whether this particular strategy in its backtested results was able to capture the pharma and tech rally during the COVID pandemic?
Oh,
That's what
that
we showed, but we'll be happy to show it again.
there you go. Pharma and tech. And I'll show you specific slides. So you can see the 40% allocation to pharma, the massive allocation to tech. And let me just show you how tech played out. So March 20, this is COVID. This is the IT index. You started taking up your exposure, and at some point you were 35% exposure to IT at that point. So of course you captured technology. Let me also show you pharma. Pharma has actually been our boldest position in the fund. So very early into COVID, we were 40% pharma. Very early into COVID, like right here. Because momentum spiked and suddenly you went from 15% COVID, 15% pharma to 30% pharma, and then went all the way to 40%.
So Radhika, the best part is underlying data during those periods. If you look at those periods, Nifty 50 index grew by 50% and 65% respectively, whereas Nifty Pharma index grew by 75 and 80. And our weightage was 28 and 40. This is how you deliver outperformance. So it's not that, the pharma did isolate, well in isolation, but it outperformed overall market. In one case by 25%, in another case by 15%. So by taking even a 25% weightage, you are participating 1/4 of the portfolio and making that additional 6%. If you made that additional 6% even by one strategy, you have had that alpha for you for one particular year.
And I will just build on what Deepak said. When people participate in a narrow sectoral fund, and there's been lots of talk of these days, because they're satellite funds, all the advice you'll get is, yeah, kar do allocation, but do some tiny allocation. So you'll do 2% allocation to some defense fund or 5% allocation to something. Even if that sector is able to generate 30% alpha on a 5% portfolio weight, it's 1.5%. It actually is not going to move the needle. You probably are better off doing something like this, where on an aggregate by doing sector rotation, you have 5% alpha.
And Radhika, just to add to your point, interestingly, it just struck me that this portfolio allows fund manager to take as much exposure as possible, and that possibility is defined by how many stocks are there in the market.
Yeah.
So if you have enough number of stocks in a sector to fill that choice that you want to exercise, it will get exercised and within SEBI limits. So if SEBI says 10% is your stock limit, we will stick to it. But can it be a 40% sector exposure? Yes, it can be a 40% stock exposure if you find 5-6 good quality value or growth companies which have momentum.
And the other thing is, because you're looking at companies as companies, you could have a sector like financials, which in theory you could argue financials is not done well over the last year and a half. But within financials, private sector banks have not done well. PSU banks, non-bank financials, power finance, these have done well. So you can capture the nuances of those sectors while skipping private banks.
I mean, just building on what you're saying, Radhika, same argument about consumers. I mean, you're perhaps negative on the entire space, but Trent has done well. It's part of our portfolio.
Great. So just, I think this question is already answered. There was a question on what's the max sector cap. It is 40%. And as we illustrated, when in the pharma upcycle of during the COVID pandemic, that's when we witnessed sector hitting the cap limit.
Yep.
So Radhika, again, if you could go back to the slide on the factors that are used in the process, because there is a specific question on which metrics are going to be used across different factors, and specifically for momentum, what is the period that you would look at to determine if a stock is in momentum?
So here you go. All the metrics are here. For momentum, it's very simple. Sometimes people think momentum is some technical magic. No, this is 3-month and 12-month price performance. The reason is we want to look at momentum that is sustainable and fundamental, hence 12-month. But we also want to get quick signals to act, hence 3 months. So it's a blend of 3 and 12 months. And the other factors you see for value, for growth, for quality.
What kind of investor should avoid a fund like this?
Deepak, take that.
Somebody who's coming to make a very quick buck in a very short period of time. Those investors should generally avoid any investment to equity, but anybody who's okay to, explore flexi cap, large and mid cap, those kind of products. I mean, this product is certainly suited for those investors.
Some key differentiating points versus other business cycle funds in the industry currently.
I think this slide is the differentiation. The differentiation is 2-3 slides. One is this is the only business cycle fund with a factor-driven approach. Every other business cycle fund follows a predictive approach of trying to forecast macro cycles, then sectors, then stocks. This is the only business cycle presentation where you would have not heard any India outlook, sector outlook, economic outlook. It is data, 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 and it's a factor-based approach. Again, I go back to this. If you look at most business cycle funds, please pick them up. The dynamism of the sector rotation is perhaps the highest in the category. And Deepak, I think I'm sure people can look at that data and get that. And finally, if you look at the output, the portfolio, many business cycle funds, I was picking up a couple today, have an HDFC, have a Reliance. The portfolio is completely different. So from input to output, it's different.
So thank you all, and thank you participants for all those very interesting questions. So just that we're running out of time, but in case you have any further questions, feel free to reach out to your investment advisor. So just before we close in, Deepak and Radhika, can we say that for us, this particular strategy is about a new approach focusing on numbers and not just on narratives, which is what we see typically a fundamental investing style doing. And so if you could just share some points as summary, both of you independently, on why a business cycle fund and what sets the Edelweiss fund apart.
So I'll go first. I think you said it well. Focusing on solving a problem all of us are grappling with today, sectors and sector timing. Focusing on solving it with a number-driven, not narrative-driven approach, and doing it by creating active management in the large and mid-cap category.
I think this is one diversified fund which is truly being active and bold and not necessarily hiding behind benchmark.
Okay, great. So thank you everyone for joining in today, and thank you Radhika and Deepak for so simplistically explaining the entire strategy to all of us. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.